I think my kind of caveat that I see with a lot of investors that are considering these is they still have to be good deals individually.
Welcome to the Good Stewards podcast, the only podcast dedicated to seasoned real estate investors who want to maximize the cash flow potential in their business. We are buy and hold investors with 1,000+ properties and markets across the U.S. who bring an insider's view into the nitty-gritty details of real estate investing. If you're looking to develop the mindset, teams, and systems that can dramatically build your real estate business and net worth, you're in the right place.
Welcome to this episode of the Good Stewards podcast. I'm Ryan Dossie.
I'm Amanda Perkins.
I'm Bill Sirius.
And I'm Andrew Sirius. Hey everyone, today we're going to be diving into portfolios, buying portfolios of properties. They could be portfolios of anything, but generally speaking, at least our experience is portfolios of houses or maybe a duplex here or there. And of course, that could be anything from a portfolio of 2 houses or a portfolio of 100 or 97, which is actually the largest purchase we've ever made. And so there are, of course, differences when buying a small portfolio and a large one, but this is a model of purchasing properties in greater volume. And it's something that we've found a lot of success with, and something that I think is a very good avenue for many investors, particularly mid to larger sized investors, to pursue, especially since it's sort of into a Goldilocks zone. There's these big portfolio investors that look to buy 100+ houses, or more often apartments, commercial buildings. But when they do buy portfolios, they buy portfolios of large numbers of houses in pretty good areas, and they got to be performing and all the rest. And so they're not going to look at C or B or even B areas. They want B plus and above, and they want fully performing. And then small investors or new investors, or even a lot of mid-sized investors, are not in the position to buy multiple properties at once or more than 2 or 3. And so this area is a good spot for somebody who has some experience, who has some resources, who's had some success, to really ramp it up, because there aren't a lot of investors in that middle area where you can buy a portfolio of 5 to 50 properties in an okay to decent area, or maybe even a not a great area if that's your specialty, and also ones that maybe need some repairs, some improvements. And so we can dive into those specifics particularly, but I guess I would open it up for general thoughts on purchasing portfolios. Anyone want to jump in here? And
yeah, I'm glad you mentioned the baby ones, because that's more where I fit in. I haven't done 97 houses. I mean, we've bought some multis where we had one where the seller had a duplex in an 8-unit. And we bought the duplex, and then because we did so well on that one, he actually ended up fully seller financing the 8-unit to us, like fully amortized out over something like 20 years. So I'm definitely a big fan of them when they make sense. I think my kind of caveat that I see with a lot of investors that are considering these is they still have to be good deals individually. Like, just because it's 38 units doesn't just mean like, well, it cash flows. It doesn't matter that they're asking, 140% of ARV. Bill and I looked at I want to say it was 50 or 60 single families that this broker had. And this guy was out of his mind on asking prices. He was like, oh, well, you just don't understand what's going on in the market. And that's why people are going to pay me more than retail for these just like, dumpy sheds I haven't maintained for 30 years.
Well, best of luck, my friend.
That was pretty much the extent of our meeting. It was kind of like, the guy was like, you're lowballing. And Bill and I were like, no, you're just optimistic is what we'll call it.
The opposite should be true. If you're buying in volume, you should be getting a discount, not the reverse. So, I mean,
I think a good deal on these, or a good example, is I know Andrew was recently looking at, I think it was 24 houses. And when you actually looked at the portfolio as a whole, the cash flow was, decent. It was like a 9 cap. But when you analyzed the deals on a basis of per property, it was an incredible deal. I mean, they were pretty much asking like 65% of ARV on these things. Whereas if you just kind of looked at it as the portfolio option, you may not have noticed just how much equity you were walking into. The perk for guys like us on something like that is we can throw individual private lenders on those. We can burr them out individually. We can even cash out, refinance them separately. You don't have to do the entire thing all in one chunk.
I think that's a really good point. There are two ways to value portfolios. There's, I'd say, the institutional way and the entrepreneurial way. The institutional way, like if you go to these large conventions with these major hedge funds that have thousands of houses. I think Invitation Homes, like a merger of several of these, has just shy of 100,000 houses right now. They have the buy box. They're looking for a gross yield, which is just a different way of saying rent to cost, and they're looking at what is their yield on these properties. That's important, but it's secondary to me. We are buying this is the Burr strategy writ large. It's just a bigger version of it. And that's the way I think you should look at it. You're buying a portfolio. It's not like buying an apartment complex where you're looking at the cap rate of it. Now, I think you do want to do that as a secondary valuation. You want it to cash flow, but you want to look at, do you have an equity position? That can be annoying. You're valuing, like when we bought 97 houses, I valued 97 different properties. It's a long process. Now, when I was making my offer, I did a quick analysis. I didn't do a detailed one, but before signing the dotted line, I went through and comped every single one of them. With those 21, we went over asking on them, and it just got blown up by another investor. I think we came in second, and but even coming in second on a portfolio of properties like that with a large amount of equity kind of shows that there aren't as many players in this market. Now, I would never say only look for portfolios because they just don't come about enough, but it is something to keep your eye on and look and kind of try to make a specialty to a degree, because there aren't as many competitors and you can get those really good deals, and you should expect them to offer a discount. Not always. The one that Ryan, you were dealing with, apparently was out to lunch, but you could just let them go have their lunch that they're out to, and then and focus on the ones that are reasonable about it, which you usually understand that there will be a discount. There has to be in order to
I'm
sell.
just upset we paid for the guy's meal. No, but in all seriousness, it blows my mind as somebody who specializes in direct to seller marketing, how few investors will get a deal done and then ask the seller, what other properties do you have?
Yeah.
Or what are you going to do with this money? You've already paid to get the lead. You've like this guy with the 8 unit. We didn't know he had an 8 unit he wanted to sell till we said, hey, what else do you have that you want to sell? And he was like, oh, I've got this 8 unit. In the same way, another incredible question you have to ask on every single deal is, who else do you know that has properties like this that they want to sell? People hang out in circles with people that are like them. So chances are, if you're dealing with, even just a totally trashed absentee owned rental, they probably know other people that have mismanaged assets. If you're talking to somebody who has, 25 units and they're looking to retire, chances are they may run in some other circles of people who own some doors and are looking to make an exit.
Yeah, I think that's an excellent point where, when I go furniture shopping, which I do occasionally for used furniture, I'm always asking the...
Can we point out used furniture? For anyone who doesn't know, if you ever get an invite to stay the night at Bill's house, you will sleep on a Craigslist mattress, which I found out after the fact.
We do have clean sleeping bags, so that's another alternative for you. But when I always ask, do you have anything else you're selling? I mean, I always ask that. And oftentimes that's when I get the better deal. Oh, yeah, well, we got this... this rarely used bed, queen bed in the back. Oh, I just need one of those. So, you always need to ask that. As a matter of fact, about 3 weeks ago, we purchased a property in Eugene from a guy named Greg. And I said, Greg, I knew he had owned a few other properties. If you're interested in selling us anything else, we'd really like to look at it. And as it turned out, he wasn't, but he was in Washington and he called me a couple of days ago and said, I have a friend who is underwater on their property. Do you think you could do anything to help? And so we talked through short sales. Now, I'm not positive his friend is going to pull the trigger on a short sale, but now we have a connection with them, and we don't really, it's a few hundred miles away, but we're open to do it if it's a good enough deal on a short sale to pull the trigger on that. So you never know when those kind of almost buying referrals might come from, and you should always.
And those are the easiest deals.
Yeah.
Like anytime we get a call and it's like, oh yeah, you bought so-and-so's house and they sent me your way. It's like, oh, this is a laydown. Like this is easy. I'm even happier when they actually like one of our competitors bought a house and they just contact the wrong company and they're like, oh yeah, you bought so-and-so's house. And it's like, sure. Okay. Sure. Moving on.
Yeah, I mean, asking that question is this sort of tangential, but it's something you should always do. I mean, one of our friends who focuses on apartments got perhaps their best deal doing a market survey where when you're buying apartments, you call the neighboring apartments and ask, what is their rent, what's their occupancy, et cetera. And just by doing that and asking like if the property was for sale, got one of their best deals in a property that they're already buying. So that wasn't the same owner, but that can that's sort of a different way to find portfolios. Sometimes you get them from individuals selling an entire portfolio they have. Sometimes they already listed it. Sometimes it's just, kind of packaging it. They're selling one, but they have three others. They might be interested in selling it. You bring it up, you bring them, they like, okay, we'll throw those in there as well. Or you can also kind of do a line item that, well, I'm not interested in that one, but I'm interested in these three or something along those lines, which can allow you to have a little bit more flexibility in finding the kind of the cream of the crop or the ones that you're the most interested in.
Now, I wonder if we ought to talk about where we've sourced some of these other than direct to seller kind of leads.
Well, like for instance, in the 97 properties, let's focus. That's sort of our biggest acquisition. Do you want to kind of talk us through?
Why don't you go for it, Amanda? Why don't you describe that one?
I can talk about the specifics of the deal, but I don't know. I don't remember exactly. I know there was a real estate agent that we were working with or a broker that had a client that had some 1031. Was that how that happened, Andrew? I don't remember exactly the specifics. It's been a few years.
Yeah. So basically there was a commercial broker actually who was calling about a house that we owned, asking if we were willing to sell it because he was trying to buy it for Quick Trip so they could expand their parking lot. And my brother Philip was being a bit of a brat and saying, yeah, I mean, he can make us an offer, but we're not really interested. And that went back and forth. And he eventually told him, asked him, so what do you guys do? And my brother explained our business model. And then he just saw this ad posted for these 97 properties on Facebook, and then got back in touch with us, which kind of leads to a general rule of thumb that everyone should know what you're doing. Your business should be loud. You don't need to be bragging or anything like that, but you should always be explaining, like, I invest in real estate, I borrow money, I buy houses, I fix them up, etc. So once, everyone sort of starts sourcing leads for you. Like, oh yeah, wait, this person's got a property for sale. This looks like a good deal. Let's shoot it off to the person I know who does real estate. So that's a general thing to keep in mind. The portfolio. I mean, when we looked at it, I mean, I've seen a lot before that. I'd seen mostly portfolios of like bank-owned properties or investors who'd had a bunch of stuff in really bad areas, just trash. And like my rule of thumb and I just actually seen a portfolio of like 93 houses, which was just the absolute bottom of the barrel garbage being sold for, I guess any sales price on trash is a premium. So it was being sold for premium. And
we're not slumlords if you're getting that vibe. We don't really manage in that asset class.
Yeah. So my brother comes over to me like, hey, have you seen this portfolio of 97? I'm like, yeah, I just saw a portfolio of 93. It's garbage. It's like, no, it looks pretty good. You want to check it out? I was like, oh, wow, this is actually very interesting. And the seller knew he was selling it at a discount. And one of the key things, we weren't in a great position to purchase it at that time. But what we did do, and this was on the recommendation of my father, just get in front of him several times, discussing the deal at length, discussing what we can do, discussing our history, why we'd manage it. Yeah, building rapport. Why would be good managers? Why we would, like, he's built this portfolio up over a lifetime. We're going to continue to maintain it. There is some connection there. Just selling it to some hedge fund is going to chop into pieces and whatever is not exactly an ideal resolution
and
to
our intention was try to see how much he would seller finance. Like we were hoping he would do a 90%.
Was just getting him to seller finance. Right. That was the first thing.
And the second thing was the more the merrier, because if we could get him at 90%, all we'd have to do is come up with 10%. And yet he, even as much rapport building as you did, which was considerable, he still wouldn't unlock himself from the need to get 25% down.
But the one thing is he did cut off negotiations with everyone else other than us, which was nice. So, I think a lot of it is figuring out what is important to a seller. And with any seller that's not institutional, there are advantages. Like they have their peculiarities, their quirks. One of the major things to him was that he didn't want to show 97 units, didn't want to do a walkthrough on 97. Now, generally speaking, if you're buying a portfolio, same with apartment, you got to walk every unit, do due diligence on every unit. But if it's the key point, the only thing this is like the key thing that he's not willing to do, okay, that's a negotiation point. And you got to be like, okay, well, we've got to assume they're going to be in a worse condition than we would like. It was pretty, take the spectrum of potential conditions based on drive-bys and assume it's the worst of those. So we did a drive-by of each property, and then we assumed that the rehab was the worst. Actually, we still probably should have bargained for a little bit more in rehab. That's a general mistake, but that's the way we took it. But that was the key thing to him. And that is something to always be with any seller. What is the thing that's important to them? Is it price? Is it terms? Is it how quickly you can close? Or in this case, is it not being a giant hassle for a guy who's liquidating his portfolio?
Yeah, I think I'll highlight that point real quick of just what is their pain point? What is it that they want? As investors, we tend to always just assume that it's more money, that it's the most cash they can get when this guy who seller financed us this performing 8 unit with nothing down carried out over 20 years. Obviously, he wasn't concerned about cash, right? He just didn't want to have to deal with it anymore. And if you try to negotiate from the standpoint of it's all price based, everything is about the money, then you're gonna miss things. We had a deal earlier this year where we were wholesaling it, and our buyer came in at the 11th hour and was like, "Hey, I need an extension." And we called the seller and we were like, "Hey, can we get another 2 weeks?" And they were like, "Oh my gosh, no." And we were like, "We'll give you more money." And that was not what they wanted. They literally would not take more money. They just wanted us to sit there and acknowledge over and over and over again how inconvenient it was for them. We were even like, "We get it, but do you want more money?" As an apology. And they were like, "No, we just want you to understand the principle of this." And it was like, okay, cool. So we even offered them more money. They didn't take it. Deal got done and everything. But I think just really making sure as you're talking to people, as you're building rapport, asking open-ended questions like, what are you going to do when you sell this? Are you moving south? Are you looking to still have consistent monthly income? Kind of pushing that seller finance angle. Don't just focus on the cash.
Yeah. And then you need to figure out how you're going to do it yourself, particularly if it's a larger purchase like this. And maybe that goes to you, Amanda, how we did actually pull off purchasing these 97 houses, which is kind of an interesting story.
You had mentioned that we talked the seller into seller financing, and I mean, the terms were good. There was amortization with it, but we still had to, it was a 75% that he was willing. So that meant we had to come up with the 25%. We had a lot going on at the time, and that 25% looked like $1.5 million that we would be leaving into a property for a considerable time, because it was going to be a while before we'd be refinancing out. And so we were connected with a family group that had just sold some investment property, and they were looking to 1031 exchange their money and defer their tax liability. So we went into title as in tenants in common. So we didn't form a partnership with these people. We're tenants in common on all the title of 97 properties with them, and then we manage it.
Can you explain what that means, Amanda, for anybody who's not familiar with it?
Also, if you're going to be doing something like this, talk to an attorney.
Yes,
disclaimer. Okay.
We talked to many attorneys. So what the difference is, so like if you're forming a partnership, you're going to be partners on an you'll probably own an LLC or some sort of a term together, and you come into the properties as partners, and there's one title. For instance, if we're Stewardship Investments LLC has a couple of partners, but we go into title as Stewardship Investments. With the tenants in common, Stewardship Portfolio, which is who we've formed, are tenants in common with our partners. And what that means is we each own a portion of each of these properties. In this case, our LLC owns 50% of the title of each property, and our partners group owns 50% in title. So
the way I've always thought about it that I think is helpful in this is a partnership is a bowl of soup, and each of you own half of the soup, and a tenant in common is a loaf of bread, and you each own one half of the loaf of bread. So it's like there is like partnership is just all a big mess. You're together. Tenant in common, it's like if it's a duplex, you own this half, they own that half. And the advantage there is, and again, talk to an attorney. I'm not an attorney. Talk to an attorney. Blah blah blah. Yeah. If somebody is 1031ing, is selling a property they own as themselves, they just own a property and they're selling it. They cannot 1031 into a partnership. Talk to an attorney, but they can 1031 into a tenant in common agreement because they're just buying this property themselves. It's not a partnership. It's got to be like to like. Partnership is not like, but a tenant in common because they're just owning this property is like. So, talk to an attorney.
So it was a pretty genius loophole you guys executed.
Yes,
that was the critical piece to make this work for them, because otherwise they would have.
It sounds like we're like leather.
Yeah, they would have lost their tax advantage if we wouldn't have been able to do this, and so that was their pain point of not losing that tax advantage. And actually, Andrew, you had a connection with somebody who had done this before that allowed us to say, "Hey, this might work out all right. We need to get an attorney who knows what they're doing." But yeah.
Attorney, lawyer, attorney. It was actually not even a connection. I mean, it was just a phone call from a friend of mine because basically we were told like this guy, he was brought to us by the same agent and brought us the deal. So it was very helpful. And we thought, and then he said they can't do it because it's a 1031 and they can't 1031 into a partnership. But I had heard 3 years earlier from a friend of mine. He called me up and he's like, "Hey, I got some people who are looking to 1031 some of their money. And I was just curious if you knew any properties for sale." And I was just thinking to myself, like, why would he ask me that? Because he does syndications. Why would he ask me that if you can't do this? So I called him up and he's like, "Oh yeah, what you do is a tenant in common. Talk to an attorney." And then I'll stop saying that. I apologize. But yeah, so it's a nice. I mean, I guess it's never, don't take no, just no is not necessarily no. We have a complicated legal code. There's a lot of different possibilities. Follow up, investigate these things because there's always ways. I mean,
always loopholes.
Yeah, that sounds kind of sketchy, but there's always things like that. Which I'll let Amanda finish this, but like we've had other deals that we closed in a different way that allowed us to keep the whole deal because we followed up on a different direction.
Maybe you ought to talk about how we financed the 41 houses that we bought at one time. That was kind of an interesting financial arrangement.
Well, one thing that I want to talk about, especially with this portfolio acquisition part, sometimes these come across your desk and you want to close it, but timing is critical here because, like, for instance, in the case of these 97 properties, these were individual houses. And while this was the seller's, life's work to acquire, basically he acquired these 97 properties. He owned them free and clear.
He actually bought some other stuff. He's kind of a boss, but go ahead. I'm sorry.
But I mean, so we took over 97 properties of people that we did not place, residents we did not place in these units. And we were limited in our ability to see inside. We did see inside some of the units. And what that means is, we had done due diligence and residents were paying the seller their rents. He worked out a lot of deals and he spent a lot of his time just managing his resident base in a way that we weren't set up to do. he made a lot of side deals as far as like what rents would allow and that sort of thing that just didn't fit great in our system. And so we didn't retain as many of those residents as we anticipated. But at that moment, we were geared up to handle significant turnover. And it wasn't just turnover, it was mini rehabs. He was not a slumlord. He had taken care of his properties. But with us, we use a certain paint color and we use certain light fixtures and that sort of thing. So if you think about a turnover, you're going to have to be planning to come in and paint the interior because we don't have the paint colors to match for touch-up paint. And, we think about it like if we do it right this first time, then it'll work better for us going forward. So we had to, these turnovers, every single one of them was more like a mini rehab.
Which reminds me about mastering locks. This is a divergent. I'll go right back to you, Amanda. But boy, if you haven't mastered your properties with a master key, you need to get on that because that is going to make your life so much more manageable. Even if it's 97 properties, you need to master them because over time, that's going to allow your key subs and other people to get in there quickly and not have it to come by and get a key from you or have a lockbox everywhere, So anyway, back to you, Amanda.
Just be very careful who you give a master key to.
Absolutely.
And make sure to track that and even have a master key agreement.
So we were working through our kinks of the 97 properties and this 41 property deal came across our desks probably 5 months, the following spring. And what had coincided with that is we had just refinanced we'd refinanced and paid off a significant amount of private lenders on some of our existing portfolio. And we had an opportunity to purchase 41 properties. And we were talking about, okay, are we going to go to a bank and finance them up front? Okay, what that means is we probably aren't going to be able to access the rehab funds. We're going to have to come up with 25%. Is this something we want to do? And for us, timing wise, it worked out amazing because we had just paid off a lot of private lenders and we were able to group our 41 property purchase closing over 3 closings, I believe, with 2 weeks apart between each one. And we did those kind of the same way we would do a one-off purchase by lining up one private lender to one property and closing them in 10 to 15 houses at a time over a month and a half, I want to say. And so timing wise for us, we were just in the right timing of our business to have access to lenders that could place 41 individual loans.
If you're buying a portfolio of 2, 3, 4, 5 houses, this is a very doable strategy, even for an investor who has some track record, but not a huge amount of track record. It's a way that you can keep all the properties instead of sharing them or creating a partnership or a syndication is too complicated and too expensive to do for 5 properties. But this is by closing them each as you would a regular house, just all together, kind of separate. Like you got a portfolio of houses, separating them and closing them individually. It allows you to buy a bigger chunk of property in a way that you couldn't do with an apartment or an office building or something like that.
Yeah, and if the seller is wary that you're not going to perform on those last 2 or 3, which I think our seller was a little wary on those 41, but if you could increase your earnest money or go hard with your earnest money on the second or third group, that let's say you're doing 6 and you want to do 2 at a time. So you just increase your earnest money or something to give them a little more comfort level that you're going to come through and keep making those purchases that you've committed yourself to.
Just make sure you've done all your due diligence before you can put more earnest money down hard to convince, or more earnest money down to convince them to allow you to split the closings up. But don't allow any of it to go hard until you've completed your due diligence and walked through each unit and gotten any inspections you think are necessary, and listen to the due diligence podcast that we've had and followed our instructions to a T. Don't let your earnest money go hard until that point.
In my experience, they already kind of think it's hard the minute it's deposited. They're kind of like, oh, if they don't close, I get this. We had one recently that during due diligence, it was like, yeah, this is not going to work. And the seller was like, well, I want the earnest money. And we're like, I mean, the contract clearly states it's not yours. It comes back to us. And Bill's quoted this a number of times, but he was like, "Oh, so you just wrote this contract where it was in your favor." Well, whoever writes the contracts always writes them where it's in their favor. Like, it's kind of a given. And the guy was like, "You guys are weasels." I'm like, all right, have a nice day.
I would probably use the angle like that is standard. This is not at all unusual to have an inspection period.
To have an out. Yeah. But I will share that each state might be different about this, but in Oregon, if the buyer and seller cannot agree about the earnest money, the escrow company is not going to step in the middle of it, make any decision. Actually, it becomes a legal matter. You have to go to court.
And cloud title too.
It's not worth it to go to court over $1,000 or $2,000, and you just have to work it out. Even though you know as a buyer you are totally in the right to get that earnest money back, it's not a lay down necessarily to do so. I had to go so far with one seller. I was totally 100% in the right. But I said, okay, how about if we give this money to charity? And they agreed to give it to charity. They wouldn't give it back to me, and I would have gone in some kind of legal process to get it, but they would agree to give it to charity. So I guess we both felt good about the outcome.
I would say the note there, though, is if you're the buyer and, like, let's say your seller just falls off the bandwagon, your earnest money staying at title clouds the title to that property. They can't sell it without coming back to you.
You can also sue to enforce a sale.
Well, yeah, you can sue, but that's the question. Yeah. How much does it take
to sue it? But as the seller, if you have a buyer walk and they refuse to sign an earnest money deposit release, they've now clouded your title and you can't sell till you get it figured out with them. So just be kind of cognizant of that.
It also might be a good idea to cap, but not necessarily cap your earnest money, but try to keep it under the maximum for small claims. Like in Kansas City, that's 5,000. So we generally try not to go above 5,000 unless it's substantially above 5,000. It needs to be. That way we can deal with it in small claims if necessary, which is much easier to go
Superior Court
above
gets pricey.
But I would say that earnest money is a great negotiating tool, because if you know you've got a slam dunk deal, it is, and there's other people hovering around, other investors or whatever, you're going to have to put $25,000, $30,000 down to make this happen. A $20,000 hard earnest money speaks volumes to sellers, and at times it's appropriate to pull the trigger and do it. If you want it bad enough, it makes total sense. And there's other people who are going to step into your place if you don't act quickly. That can be the difference maker.
I would say if you want it bad enough and the deal makes sense.
I think I did say the deal makes sense, didn't I?
Be a component. I think we should probably bring things to a close here. Is there any other final parting thoughts that anyone would have on buying portfolios of houses and small multis?
I'll hop in on one thing just because it kicked my teeth in this year, especially when it comes to apartments. Make sure you're verifying rent rolls with bank deposits. We bought a 12 unit that was fully performing. The seller introduced us to the banker who funded the deal. And then we closed and it's like everyone picked up a heroin addiction that week. Like the building just literally started to fall apart with the residents. And I forget the exact number of evictions we had, but I think in a 12 unit building, we had to get rid of 8 people. So what went from wow, this is awesome, we bought a 12 unit, turned into, gosh, I don't know that I ever want to buy a 12 unit again. So it's one of those things that's not that hard to verify, but especially on portfolios like this, a lot of the times you have mom and pop lenders that they pay in cash and you want to actually know what the property is doing before you buy it, not buy it and have what we had happen, which we knew we were going to have to turn these units. We call it FAIR, future anticipated repair expenses. We knew these units were going to need to be redone at some point. We just didn't think it was going to need to be redone in the first 45 days.
And you can get bank statements or tax returns, but the best is deposit slips, copies of the deposit slips.
The sad thing too is it didn't allow us to negotiate more aggressively. If we would have had that knowledge,
I think we still ended up, it'll be a good deal, but it went from a great deal to this is decent.
Well, that would really be my point. When you are evaluating and considering your offer, plan for the worst case scenario. hope for the best, but you really need to plan for that worst case scenario and manage your expectations accordingly, because you can get really down in the dumps about, oh, I thought this was just going to be so easy. We had, for instance, in the 97, it's like, I think maybe there were 8 to 10 vacants at the time that we closed. And, we've never had to go to ourselves or our partners, our tenants in common in this, and ask for more money. We've always been able to do all of the rehab with the cash flow from the property, but it definitely hasn't, it's grown, about $4 million in equity since we purchased. We had some inherent equity just by getting the good deal. So it's grown a lot in value, and we have great residents in there and we have good cash flow. But it's just, we had to work on managing the expectations of ourselves and our tenants in common in there, because they were expecting probably higher returns as it goes along. They got a good deal and we got a good deal and we're happy to have it. But you just have to be realistic in what your expectations are.
I underestimated the rehab.
Oh, I'm not blaming. No.
I think I would also, on Amanda's point, especially with partnerships, you have to have that kind of an honest relationship of, hey, we messed this up. We need more money. Bill and I had a partner who I won't name that just didn't communicate with us. So when things weren't going well, he would get quiet. It's kind of like, if you're married, if stuff's not going well, you should be communicating more, not talking to each other less. And when you have a partnership, you have to, Bill loves the Jim Collins quote, but you've got to face the ugly, the brutal truth. You have to face the facts before you can move forward. I think there's people that had they been in your guys' position back then with that deal, that portfolio would have imploded because they wouldn't have asked for help. They would have tried to rob Peter to pay Paul, and it would have just gone up.
I mean, like I said, it was still a really good purchase because we never had to go to them and say, oh, we need money to pay for this. I mean,
I think we did have to manage, though, what we had to manage their expectations after the fact.
We had some zero cash flow months. And I think one of the things you have to be clear to your partners going in, or tenants in common, that might happen. There might be capital calls. You don't oversell things because it will come back.
Always been so transparent with them, and they appreciate that. They can see every single thing that's ever happened in the big
and we've had really good accounting
financials. Yes.
The accounting has been critical. Anytime you have a partner syndication, outside partner, boy, be spot on with your accounting. That is so critical.
Absolutely. Well, I think we went over a little bit, but that's okay. It's just free. It's bonus content. I guess these podcasts are free to access anyways, but regardless, we'll call it free, even more free than the free that you normally get. And we will call that an episode. Thank you very much for joining us. Please go to our website at goodstewards.com. Please subscribe to our feed for more real estate and business information. And thank you again.